All right, we're live.
Okay. Hi there, my name is Rachel McQuaid, and I'm a journalist at LTC Tree. I'm here today with Drew Nichols, co-founder of LTC Tree, to talk about some important changes that are coming up in the long-term care insurance market later this year. Hey Drew, how are you doing today?
Hey, Rachel, I'm doing good. Thanks for meeting with me online today.
Yeah, thanks for talking with me. So I guess my first question for you is, and by the way, for anyone who's watching this, I'll be posting a blog post with all this information later. But Drew, what sorts of changes are we going to be seeing this summer?
Well, Rachel, the largest insurance provider in the long-term care market is going to be rolling out a new generation of policies. And we know this because they have mentioned it over the last couple of quarters in their conference calls with their stockholders. And so we've been able to get a little bit of kind of pre-intelligence, if you will, on what's coming and when it's coming. And we're expecting some changes to come this summer that means that the bottom line for consumers is if you're waiting to buy a long-term care policy, you're probably going to be spending a little more money if you buy the next generation of policy.
Okay, so why exactly are prices going up? And how can someone who is possibly thinking about buying coverage now benefit from knowing this information?
Yep, it's a good question. There's a couple reasons why prices are going up, and we can maybe dig in a little deeper on that. Basically, over the last couple of years, we've seen a trend in this industry of new generations of policies being rolled out pretty routinely, about once a year or so. And every single time, they've kind of ratcheted down they're becoming more conservative. So in other words, they're charging more for the same risk. And we're seeing that trend continue this summer.
Okay, can you give me any more specifics on exactly what's changing with the new policies?
Yeah, there's two things that are changing that we know will make these policies a little bit more expensive. The first is when they price a long-term care policy, they have actuarial scientists that build models and algorithms for, okay, we're going to collect this much in premiums and our risk level is this, so we expect to pay out that. One of the things that they're changing is the lapse ratios of these policies. And for those that don't think about insurance every day, I'll kind of break that down a little bit. What they're expecting is that literally 99%, less than or more than 99%, less than 1% of people will cancel a policy. So every year, 99% of people who have a long-term care policy are going to keep it. That's a very conservative assumption in this market. The other thing that's changing is interest rate assumptions. And again, we're getting kind of inside baseball a little bit here, but those two things are going to result in higher premiums for people that are waiting to buy a long-term care policy if they wait.
Okay, so the bottom line is that if they wait, they're going to be paying more, correct?
Yes. So looking over some slides that we've received from one of the companies, they're reducing their interest rate assumptions and reducing their lapse rate assumptions. The net of it is we're probably going to be looking at about a 20 to 30% rate increase on new policies sold after this kicks in. We don't have a specific date yet, but it's going to be sometime we're thinking June or July is when they start rolling this out.
Okay, that sounds good. So there's not really a specific time, so if people are looking now, then they should start making decisions to avoid that rate increase.
Exactly. The way these policies work is when you buy one, you're kind of grandfathered into that policy rate structure. So, for example, if you'd bought a policy 10 years ago when things were a lot cheaper, even though your rates may have gone up, you would still be spending significantly less money on your insurance and covering your risk than if you were to buy something now. So, to answer your question, people should start looking at this pretty seriously now so that they can get grandfathered in ahead of these changes coming.
Okay, great. Well, I really appreciate you explaining all of that. Is there anything else that you want to add?
Well, yeah, and if you're going to write a blog post on it, maybe we can chat about any other pointers you have. But I think the key thing that we want to get out to consumers is that it's not too late right now to get to get into the current generation, get grandfathered into these rate structures. That's the main thing I think we want to emphasize is that there's still a little bit of time, but it's kind of running out.
Right. Okay, that makes sense. Great.
Yep.
I really appreciate you taking the time to talk with me and explain all of that. I hope that people can benefit from knowing this information ahead of time because, as you said, things are changing and they're going to be happening soon.
Yeah, yeah. Well, and thanks for writing that blog post for us. We'll be sure to email it out to our clients as well.
Sounds great. Well, I appreciate it.
All right. Thanks, Rachel. Have a good one.
Thanks, you too. Bye.
Bye.